I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. The Bond Book by Annette Thau is a comprehensive guide to investing in bonds. It is a well-written, easy-to-understand book that covers everything from the basics of bond investing to more advanced strategies. If you're looking to diversify your investment portfolio, or just want to learn more about bonds, this book is definitely worth a read. Thau starts off by explaining what bonds are and how they work. She breaks down the different types of bonds, such as government bonds, municipal bonds, and corporate bonds, and explains the risks and benefits of each. She also goes into detail about bond ratings, bond prices, and yield curves, which can be helpful for those who are new to bond investing. One of the great things about the Bond Book is that Thau provides practical advice for investors. She offers tips on how to choose the right bonds for your portfolio, how to evaluate bond funds, and how to read financial statements. She also includes sample portfolios for different types of investors, which can be a helpful starting point for those who are just beginning to build their bond portfolio. In addition to providing advice for individual investors, Thau also covers topics that are relevant for institutional investors. For example, she explains how pension funds, insurance companies, and other large investors use bonds to manage risk and generate income. Throughout the book, Thau emphasizes the importance of diversification and risk management. She explains how to build a diversified bond portfolio and how to manage risk by investing in bonds with different maturities and credit ratings. One of the strengths of the Bond Book is Thau's writing style. She manages to make a complex topic like bond investing accessible to readers of all levels. Her explanations are clear and concise, and she uses examples and charts to illustrate key concepts. Overall, the Bond Book is a valuable resource for anyone interested in investing in bonds. Whether you're a seasoned investor or just starting out, this book provides the information you need to make informed decisions about your investments. It's a must-read for anyone who wants to build a diversified portfolio and manage risk effectively. Bonds are a type of fixed-income investment that pay regular interest payments and return the principal at maturity. When an investor buys a bond, they are essentially lending money to the bond issuer, such as a corporation or government entity, in exchange for a promise to receive interest payments and repayment of the principal amount borrowed. Bonds have a set interest rate, or coupon rate, which is typically paid out on a semi-annual basis. The interest rate is determined by a variety of factors, including the issuer's creditworthiness, market conditions, and the bond's maturity. Bonds can have different maturities, which range from a few months to 30 years or more. Short-term bonds typically have lower yields but less risk, while long-term bonds have higher yields but are more sensitive to changes in interest rates. When a bond reaches maturity, the issuer is obligated to pay back the principal amount to the investor. However, bond prices can fluctuate in response to changes in market conditions, interest rates, and the creditworthiness of the issuer. If an investor sells a bond before its maturity date, they may receive more or less than the face value depending on the bond's price at the time of sale. Overall, bonds are a popular investment choice for those seeking a steady stream of income and a relatively low-risk investment option. They can also be an important part of a diversified investment portfolio. There are several different types of bonds available for investors, and each type has its own risks and benefits. The 3 main types of bonds are government bonds, municipal bonds, and corporate bonds. Government bonds are issued by the federal government or one of its agencies and are considered to be among the safest types of bonds. They are backed by the full faith and credit of the U.S. government, which means that the likelihood of default is very low. As a result, government bonds typically offer lower yields than other types of bonds. Municipal bonds are issued by state and local governments and their agencies to finance public projects, such as schools, roads, and hospitals. They offer tax benefits to investors, as the interest income is generally exempt from federal taxes and may also be exempt from state and local taxes. Municipal bonds can range in credit quality, with some offering lower yields and lower credit risk than others. Corporate bonds are issued by corporations to finance their operations, expansions, or acquisitions. They typically offer higher yields than government and municipal bonds, but also come with higher credit risk. The creditworthiness of a corporate bond issuer is assessed by rating agencies such as Standard & Poor's, Moody's, and Fitch, which assign ratings based on the issuer's ability to meet its debt obligations. Higher-rated bonds are considered to be less risky, but offer lower yields, while lower-rated bonds carry more risk, but offer higher yields. Within each of these broad categories, there can be further distinctions based on the bond's features and characteristics. For example, government bonds can be issued with different maturities, such as Treasury bills, maturities of 1 year or less, Treasury notes, maturities of 2 to 10 years, or Treasury bonds, maturities of more than 10 years. Municipal bonds can be issued as general obligation bonds, backed by the full faith and credit of the issuer, or revenue bonds, backed by specific revenue streams, such as tolls or fees. Corporate bonds can be issued with various features, such as convertible bonds, which can be converted into stock, callable bonds, which can be redeemed by the issuer before maturity, or high-yield bonds, which offer higher yields, but come with higher credit risk. Overall, understanding the different types of bonds available and their associated risks and benefits can help investors make informed decisions about their bond investments. Bond ratings are a way to assess the creditworthiness of a bond issuer and the likelihood of default. Rating agencies such as Standard & Poor's, Moody's, and Fitch use a standardized system to assign ratings to bonds based on the issuer's ability to make interest payments and repay the principal amount borrowed. Bond ratings typically range from AAA, the highest rating, to D, default, with lower-rated bonds carrying a higher risk of default. Bonds rated BBB or higher are considered investment grade, while those rated BB or below are considered speculative or high-yield bonds. The rating agencies consider a variety of factors when assigning ratings, including the issuer's financial strength, the stability of its earnings, and its ability to generate cash flow. They also consider external factors such as the economic and political environment and the competitive landscape of the issuer's industry. Investors use bond ratings to assess the creditworthiness of bond issuers and make informed investment decisions. Higher-rated bonds are generally considered to be less risky, but they also offer lower yields. Lower-rated bonds may offer higher yields, but they also carry a higher risk of default. It's important to note that bond ratings are not a perfect indicator of creditworthiness and should not be relied on solely when making investment decisions. Investors should also consider other factors, such as the bond's yield, maturity, and market conditions, when evaluating bond investments. In addition, bond ratings can change over time as the issuer's financial situation or market conditions change. An issuer's rating can be upgraded or downgraded based on changes in its financial strength or creditworthiness, which can affect the bond's price and yield. Overall, understanding bond ratings and how they are assigned can help investors make informed decisions about their bond investments and manage risk in their portfolios. I can explain point 4 from the bond book in more detail. Interest rates and inflation can have a significant impact on bond prices, and bond yields are influenced by market conditions. Bond prices and yields have an inverse relationship, meaning that as bond prices go up, yields go down, and vice versa. The price of a bond is determined by its face value, or the principal amount borrowed, and the interest payments the bond generates. When interest rates rise, the prices of existing bonds fall because they offer lower yields compared to newly issued bonds. Conversely, when interest rates fall, the prices of existing bonds rise because they offer higher yields than newly issued bonds. Inflation can also impact bond prices and yields. When inflation rises, the purchasing power of the interest payments generated by bonds decreases, making them less attractive to investors. As a result, bond prices fall, and yields rise to compensate for the increased inflation risk. Bond yields are also influenced by market conditions, such as supply and demand dynamics and changes in investor sentiment. When demand for bonds is high, prices rise, and yields fall. Conversely, when demand for bonds is low, prices fall, and yields rise. Yield curves, which plot the yields of bonds with different maturities, can provide insight into market expectations for interest rates and inflation. A normal yield curve slopes upward, with long-term bonds offering higher yields than short-term bonds. An inverted yield curve, where short-term bonds offer higher yields than long-term bonds, can be a signal of an impending economic downturn. Overall, understanding how interest rates, inflation, and market conditions impact bond prices and yields can help investors make informed decisions about their bond investments. Investors should consider these factors along with the creditworthiness of bond issuers and their investment goals and risk tolerance when evaluating bond investments. Bond funds offer investors a diversified portfolio of bonds, but they also come with risks and fees that should be carefully considered. Bond funds can be actively managed or passively managed, and they can invest in a variety of bond types, including government, municipal, and corporate bonds. Actively managed bond funds are managed by professional portfolio managers who make investment decisions based on market conditions, interest rate movements, and other factors. These funds typically charge higher fees than passively managed funds, but they offer the potential for higher returns if the manager's investment strategy is successful. Passively managed bond funds, also known as index funds, track a specific bond index and aim to match its performance. These funds generally charge lower fees than actively managed funds, but offer lower potential returns. Investors should carefully consider the fees and expenses associated with bond funds, as they can impact returns over time. Expense ratios, which represent the percentage of a fund's assets that are used to cover operating expenses, can vary widely across bond funds. Other costs associated with bond funds may include transaction fees, sales charges, and redemption fees. Investors should also consider the risks associated with bond funds. While bond funds offer diversification benefits, they are still subject to market risks such as changes in interest rates and credit risk. Investors should also be aware of the specific risks associated with the types of bonds held in the fund, such as inflation risk, default risk, and liquidity risk. Overall, bond funds can be a convenient and cost-effective way for investors to gain exposure to a diversified portfolio of bonds. However, investors should carefully consider the fees and risks associated with these funds and evaluate their investment goals and risk tolerance before making an investment. Asset allocation is an important consideration when building a bond portfolio. Investors should evaluate their investment goals, time horizon, and risk tolerance to determine the appropriate mix of bond types and maturities for their portfolio. Investors with a shorter time horizon or lower risk tolerance may prefer to invest in shorter-term bonds, which are less sensitive to changes in interest rates and offer lower returns, but also come with lower risk. Short-term bond funds or individual bonds with maturities of 1 to 3 years can be a good option for these investors. Investors with a longer time horizon or higher risk tolerance may prefer to invest in longer-term bonds, which offer higher yields, but also come with higher risk. Long-term bond funds or individual bonds with maturities of 10 years or more can be a good option for these investors. Diversification is also important when building a bond portfolio. Investors should consider investing in a mix of bond types, such as government, municipal, and corporate bonds, to manage risk. They should also consider investing in bonds with different credit ratings, such as investment-grade and high-yield bonds, to further diversify their portfolio. Individual bonds can be purchased directly from bond issuers or through a broker, while bond funds can be purchased through a brokerage account or directly from the fund company. Investors should carefully consider the fees and expenses associated with each option and evaluate their investment goals and risk tolerance before making an investment. It's also important to periodically review and rebalance your bond portfolio to ensure it remains aligned with your investment goals and risk tolerance. Over time, changes in market conditions and interest rates can impact the performance of your bond portfolio, so it's important to regularly evaluate your investments and make adjustments as needed. Overall, building a well-diversified bond portfolio requires careful consideration of your investment goals, time horizon, and risk tolerance, as well as the risks and benefits of different bond types and maturities. By taking a thoughtful approach to bond investing, investors can manage risk and generate steady returns over time. Diversification is key when it comes to managing risk in a bond portfolio. Investors can diversify their bond portfolio across bond types, issuers, and maturities to help manage risk and potentially improve returns. Diversifying across bond types involves investing in different types of bonds, such as government, municipal, and corporate bonds. Each type of bond carries its own risks and benefits, so diversifying across bond types can help manage risk and potentially improve returns. Diversifying across bond issuers involves investing in bonds from different issuers, such as different corporations or government entities. This can help spread risk and reduce exposure to any one issuer. Investors can also consider investing in bonds from different countries to further diversify their portfolio. Diversifying across bond maturities involves investing in bonds with different maturity dates, such as short-term, intermediate-term, and long-term bonds. Short-term bonds are less sensitive to changes in interest rates, but offer lower yields, while long-term bonds are more sensitive to changes in interest rates, but offer higher yields. Investing in a mix of different maturities can help manage risk and potentially improve returns. It's important to keep in mind that diversification does not eliminate risk, but it can help manage it. Investors should also be aware that diversification can impact returns, as higher returns are typically associated with higher risk. Investors can diversify their bond portfolio by investing in individual bonds or bond funds. Bond funds offer the advantage of instant diversification, as they invest in a portfolio of bonds. However, they may come with higher fees than individual bonds, and investors should carefully consider the costs associated with investing in bond funds. Overall, diversification is an important tool for managing risk in a bond portfolio. By investing in a mix of bond types, issuers, and maturities, investors can spread risk and potentially improve returns over time. It's important to carefully consider the risks and benefits of each investment option and evaluate your investment goals and risk tolerance before making an investment. Reinvestment risk is the risk that an investor will not be able to reinvest the proceeds from a bond investment at the same rate of return when the bond matures or is sold. This risk can arise when interest rates decline, as the investor may not be able to reinvest the proceeds at the same rate of return as the original investment. When interest rates decline, bond prices rise, and the yield on the bond decreases. If an investor sells the bond before maturity, they may receive more than the face value of the bond, as the bond's price reflects the current market conditions. However, when the bond matures, the investor must reinvest the proceeds at the prevailing interest rate, which may be lower than the original rate. For example, suppose an investor purchases a bond with a 5% coupon rate and a maturity of 10 years. If interest rates decline to 3% after 5 years, the bond's price will rise, and the investor may be able to sell the bond for more than the face value. However, if the investor reinvests the proceeds at the prevailing 3% rate, their return will be lower than the original 5% rate. To manage reinvestment risk, investors can consider investing in bonds with shorter maturities or laddering their bond investments. Laddering involves investing in bonds with different maturity dates to help manage interest rate risk and reinvestment risk. By investing in a mix of short-term and long-term bonds, investors can ensure a steady stream of income while also potentially benefiting from rising interest rates. It's important to keep in mind that while reinvestment risk can impact returns, it can also provide opportunities for investors to reinvest at higher rates of return. By keeping an eye on market conditions and interest rate movements, investors can potentially benefit from reinvesting at higher rates when opportunities arise. Overall, managing reinvestment risk is an important consideration for bond investors. By investing in a mix of bond maturities and keeping an eye on market conditions, investors can help manage this risk and potentially improve returns over time. Callable bonds are bonds that can be redeemed by the issuer before the maturity date, typically at a premium to the face value of the bond. Callable bonds can provide benefits to issuers by allowing them to refinance at a lower rate, but they can also pose risks to investors. When a bond is called, the investor is typically paid the face value of the bond plus a premium. While this may seem like a benefit to the investor, it can also result in the investor losing out on potential future interest payments. If interest rates have declined since the bond was issued, the investor may not be able to reinvest the proceeds at the same rate of return. To manage the risks associated with callable bonds, investors can consider investing in non-callable bonds or bonds with longer maturities. Non-callable bonds cannot be redeemed before the maturity date, offering investors a more stable income stream. Longer-term bonds may also offer higher yields, but they can be more sensitive to changes in interest rates and market conditions. It's important to carefully consider the terms and conditions of callable bonds before investing. The prospectus will provide information on the call dates, premiums, and other terms associated with the bond. Investors should also be aware of the creditworthiness of the bond issuer and evaluate the risks and benefits of callable bonds compared to other investment options. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.